Unavailable funds fee. An unavailable funds fee is a penalty fee applied by a bank on a transaction account when a transaction is posted to an account that has negative available balance even though it has a positive physical balance. The fee is distinct from a non-sufficient funds fee as there is a positive physical balance but some or all the funds are on hold, meaning that the balance is not yet available. Bank fees such as the unavailable funds fee are contentious and have been the subject of some debate. Consumer advocacy groups have criticized them as opaque and unfair and that they particularly penalize the poor, and fees do not reflect the bank's costs. The banks argue that it is a penalty, not a transaction fee. These fees have become a major source of income for banks, replacing the traditional account and transaction fees which in many countries have disappeared. Overview. The unavailable funds fee, not to be confused with the non-sufficient funds (NSF), overdraft, exceed hold or over limit fees, is a fee that results from a transaction that posts to a negative available balance and a positive physical balance, as applied to a demand deposit account, usually a checking account. The fee is typically applied at the end of the business day, as most banks process transactions at the end of each business day. An account has two distinct balances, a posted balance, or physical balance, and an account balance. The difference comes from transactions that have been applied to the account but have holds against them. To understand how an unavailable funds fee comes about, it is important to understand the difference between the two types of balances. Posted balance. The posted balance is money that physically is in the account. This balance is the result of a transaction that has a date in the past. This is the actual or the real balance of the money in the account. Available balance. The available balance is the posted balance minus the total of the holds that have today's date or a date in the future. For example, if a newly opened bank account contains $100 with $20 on hold, the available balance will be $80. Holds. A hold is money that the bank has either chosen or is not allowed to make available to the customer yet. Holds originate from check deposits waiting to clear, notice of returns, notice of collection, debit card purchases or direct deposit. A hold is assigned a dollar value in a time frame, typically between 1 and 14 days. Holds are not permanent, and once the reason for the hold has been resolved, it either becomes a posted transaction or the payment is reversed. At this point, when a transaction posts, a fee can be generated. To illustrate this, the following example shows a number of transactions and the hold balance over a period of 7 days, starting the January 1, 2006 until January 7, 2006. Example. The following bank statement shows a customer that has overspent by 1 penny and as a result has generated 5 fees. The overspending fee used in the example is $30, which is typical for the banks that charge this type of fee. These fees occur when a transaction posts to the account and the available balance is negative. In this example there is 5 purchases, $10 for gas, $35.01 for net, $15.00 for phone, $15 for music and $25 for food, total equals $100.01, and a standard deposit hold period. Governance. United States of America. Not all overspending fees are officially defined or regulated in the United States. It is up to the individual bank to decide if the unavailable funds fee should be applied. Instead, it could dishonor the payment to avoid a customer getting into a position where the fee applies.